Hello, World Globe. This is Timothy Green, bringing you to the treasure again. And we're going to look at this old video. And we're going to listen how they tried to jump tracks and get run over by a train. Because that's part of the market too. And nobody knows if you miss that train, it's gone. So welcome to Timothy Green, investment, stock market, and buying school.
Over the ice and dealing with snow and freezing. It's also a very different moment right now in Wall Street that everyone's assembling. And frankly, on the heels of the pandemic, a quieter Davos, but one that's also more serious and focused.
More serious like 2009, 2008, but different. You brought it up earlier, and again, we brought it up last week. It's not a Davos of catharsis out there or emotion. It's just the slog in interest rates and the worry about recession grinding along through this 2022.
And a changed geopolitical landscape really highlighted by the fact that Russia is not here. And all that entails, the idea that we have a very shifted landscape that we're looking at right now. What does it mean to be globalized in a world where people are trying to find how to get things
when you invested in the bank with the market invested with other market, with other banks across the globe. And when one bank is in trouble, a payday account, and they in the market or investment,
because Christine Lagarde
see the red
in a note, and she basically was saying that she sees
is already done. The green is supposed to be good, and it's counting. It's supposed to be counting up, but when it counts up, it counts all the money is being made. That the money that's being made is going to be full up into the bank account that the bank have to pay to the market. And that's when the market going to clean it up and drop it back down because they owe a bill to a account that they took money out and tried to erase it. And they have an account raising money with no name that the market already paid for that money to be in the bank. Now, I'm not going to tell you too much because I need you to learn what's going on for yourself. Because this is why great investment don't give you the answer, because anything can happen, and then you goes along with that, and the market drop. Then you can say, "Oh, he gave me the wrong thing in the market." Nah, I'm not going to try to April Fool you. I want you to read it and listen of what they saying. And what they saying is involved with the bank. Every introductory money that got to go into the bank. Now here's a lady right here. She on board. Let's listen to her.
So there's a lot of people saying, where are we going? Not just the next month or next quarter, but the next 5 to 10 years. If we do deglobalize or regionalize, what does that look like? What are the implications of that? As well as the short-term worries over will the Fed tighten enough to get inflation back down to its target? If we have higher, stickier inflation for longer, how does that flow through to the market? So a lot of uncertainty if I had to sum it up.
How do you determine whether a move like what we're seeing ahead of the open today is a head fake or not?
Well, we don't trade daily wiggles in the market. So we take a step back and say, okay, what's discounted? A lot has changed since the beginning of the year. I think the biggest change has been discounted tightening by central banks, particularly the Fed. And we have seen that flow.
She always on board. You can't help but love her.
So far,
for being
largely a
truthful.
function of the change in discount rates. You haven't seen a major change in expected earnings growth. And so that to us is the thing we're watching. If this is a head fake or continuing, that
I
would be the
can't get
shoe
a
to drop.
clear,
If the Fed continues to tighten to try to reduce demand, to
can't
get
get a
inflation
clear
under
picture.
control, I would expect to see that flow through into discounted growth,
I need my
which
money to
then
get a better
eventually should bring
equipment.
equities that next leg lower.
For years, people were saying that markets were benefiting even though the economy was not. And that actually we saw all of the financialization represented by
The
an
market's
S&P on
supposed
a
to.
vertical trajectory.
That's what we
Are we heading into
invested
the
in,
opposite? Can
the
we be heading into
market.
the opposite, where we see markets
And when
lag behind an economy that continues to be
you
strong?
have your money
That
going
has
to
been
the
our view,
bank,
continues to be our view as
and
we
the
look
bank
ahead,
is
that
part of the
we're in a
market,
situation now where the
but
nominal
when the
economy
bank
is likely to
break the
outperform
contract
financial
with the
markets
market,
fairly substantially.
what do you
And
think
that is
supposed to
mainly a
happen?
function of the policy reaction we got during the pandemic. All the fiscal and monetary stimulus that came through and left households wealthier than before the pandemic, corporate balance sheets stronger than before the pandemic, it gives them a cushion to withstand the tightening. So it is going to feed through to markets. And obviously that wealth effect will also feed through to the economy. But that starting strong nominal point for the economy means financial assets could underperform.
You've got it, Bridgewater, in your fancy kitchen. They get the whole Sub-Zero thing.
I love the way you
Well,
put
look who's
that.
talking. Bloomberg Kitchen. Hello.
Living
You
in
got
the last
the Ray
house.
Dalio Memorial Pressure Cooker. And the only reason he hired you is the steam coming out of the kettle is the currency market. To me, the conundrum here, and you beautifully described the fiscal impulse and the wealthing that occurred, and maybe the de-wealthing that's occurred now.
Hello.
What releases the pressure is dollar dynamics.
Mm-hmm.
What kind of pressures will we see?
Well, I think the most important thing to understand about the dollar right now is how quickly our external need for foreign capital is increasing. So if you go on your Bloomberg page, it'll show our current account deficit for the United States at around 3.5%, which is already a big widening. Mm-hmm. Our timely estimates suggest that's closer to 5 or 6% of GDP. And so for the dollar to stay supported, we need to continue getting enough capital to offset that. And we think there's a growing risk around that. So the dollar, we think, is vulnerable on a cyclical basis and also a structural basis.
This is important. It's Steve Roach 101. Someone has supported us for years here. And at Davos, if we get a twin deficit, do you link those two together mathematically or philosophically? Do you link current account with recession gloom together, or are they two separate events?
Well, they are mathematically linked, as you know well, Tom.
Yes,
You're being
they
humble.
are.
Yeah,
Hello. Hello. Yes, he
but
is.
I think what we're following.
He's trying to do a Judge Judy on you.
Surveillance tip. Yeah. Don't ask the question unless you know the answer. It's just like Judge Judy. Continue.
Hello.
So the current account, the balance of payments is what I'm focused on relatively more. And so that financing need is the canary in the coal mine. If U.S. growth continues to outperform the rest of the world, if interest rates in the U.S. continue to be so much more attractive, both on an absolute level and on a change basis, then maybe the U.S. does continue to hold up for the dollar, but it's a question mark.
So where does the money go if it doesn't go to the U.S.?
Well, let's look. I mean, year to date, Japanese equities are actually outperforming U.S.
So they
equities.
just spending my money as well.
UK stocks are outperforming U.S. stocks. Some emerging market equities are outperforming. And so not all the capital is flooding here. It is looking for opportunities where policymakers are less constrained, where valuations are a lot less demanding, where positions, where exposure is a lot more moderate.
What you said about
because that's involved with the bank.
How high do Treasury yields have to go in order to remain that attractive to support the dollar?
That's a great question, and I don't have a number for you, but what is interesting to us when we look at the bond market, so we try to understand all the different players in every market, what motivates them to buy or sell. And when we look at the U.S. bond market today, even though you have less issuance, for the Fed flipping from quantitative easing to quantitative tightening is obviously very significant. But the big player that we're watching that we think is suggests more upside for bond yields are banks. So a year ago, you had
Come on, baby, give it to
you had
him.
a ton of deposits coming in, and the banks were putting
Not
that
that
into
sweet
bonds.
thing,
So you had
is
a
it?
lot of demand keeping down the yield. That's over. The curve is flatter. The deposit inflow is slower. So there's less bank buying of bonds to hold down the yield. So when we look at who's going to buy those bonds if the Fed's out, we still see a supply-demand imbalance that to us suggests yields higher. I don't know what the magic number is, but we still think we have further to go on the upside.
Oh, they got a long way to go. Everybody deal with the bank.
Trust me, folks, it is perfect.
It's going to hurt the economy before it hurt the bank, because the bank has already broken the contract. It's counting money, taking every money from the bank. That's from the companies under the portfolio.
Risk parity? Or are we talking about, So what's so interesting to me about all of this is when you think about how most investors in the world have positioned for the last 1 or 2 decades, they have been biased towards rising growth and falling inflation. That's 60-40, right? You're going to do your equities do well, growth is rising, et cetera. Right. It worked great till now, and the world has gone upside down. So now we have falling growth and rising inflation. Obviously, we've seen the portfolio hit folks have taken. The difference with risk parity strategies is that they're balanced for growth and inflation. So even if bond yields are going up, you have balance in other parts of the portfolio, namely commodities and other inflation-sensitive assets.
See, you just can't help but loving her. Honestly, Lee.
If they let me go back to New York, can you come back and visit us to
No.
this discussion?
Of course, always.
To me, it's the
What?
financial question for our listeners and viewers is the death of 60-40
right
calibration.
Every time I get a woman, all the mans want her. They ain't never want her
Maybe we won't go back to New
when
York.
I don't want her. They want her when I want her. Well, Lisa, I'm back with you now, baby.
Work remote from there you go. I was waiting for it. Here we go.
There we go. We're going to continue on here. We've got much more coming up through the next number of days, including an important conversation with the former Secretary of State, John Kerry, a special presidential envoy for climate.
That green's supposed to be good. It's counting down. It's collecting money. And once it get enough money, and when all of them is red, then they go back green, start counting again. Like I said, high under zero is not good. Hey, let's not go there. China going down too. They got too many Chinatown in the United States. All in the black neighborhood, all downtown, all in the white populated stores, making American money, sending it back over to China, cleaning it up, sending China money to China people, and they use Chinese money in American and take American money. And they think they're not supposed to be hurt. People buy. It's time to go. Hey, I'll get back with you. Welcome to Timothy Green, Investment, Stocks and Bond School. And I'll hit you up on some more of these old videos. And I do hope I get my money. If I don't, I got to move on. I want my big equipment so I can help to show people how to make the right investment. Some people are just good in some things, and some people are not. So we'll get back with Boomberry.